In this week's video, we'll cover walking the fine line between patience and risk management in today's stock market. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with two DeMark charts that help us understand market probabilities. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is a daily chart of the S&P 500 futures as of the close on Friday. Prior to Friday's session, these are probabilistic targets down here. Think of them somewhat as Fibonacci levels based on ebbs and flows. This is an area here prior to Friday's session where it would not be unusual for a market making this type of pattern to move all the way down towards 2,000 on the S&P 500 futures. The good news from a probability perspective, after or during Friday's session, that probabilistic area moved from way down here to roughly the low or somewhere in the neighborhood of 2060 on the S&P 500. This is a reason from a probability perspective to try to remain patient. Also note, this red diamond here is gone now, basically saying that target's been hit. Often when that happens, you rally in the other direction or you break down. The upper magnet or potential target for the S&P 500 futures is at 2189, telling us in the short run here, our risk-reward ratio to try to see what happens in this area here is quite favorable. Now we're looking at a 60-minute DeMark chart for the S&P 500 index. This is another set of indicators and or data or hard evidence that was helping us try to remain patient and walk that fine line between patience and risk management during Friday's session. 60-minute chart. We get a 9 and a 13 telling us that the probability on this chart of trend exhaustion in this direction is higher now once we hit this 13. Works the same way in this direction. A 9 and 13 tells you the probability of a reversal is higher. 2, this is a TDST level. DeMark uses it as somewhat of a trend demarcation line. In the simplest terms, when price stays above this line, the trend on a 60-minute chart tends to be up, and when you break below it, especially a qualified break, the probability of a trend reversal starts to increase. We stayed above it. The level was 2067. We also have our magnet or our teal diamond here up at 2093. If price breaks down into this area here, it also helps us with bearish probabilities. We get similar try to be patient evidence in the short run from the standard charts used by the CCM market model. This is a daily chart of the S&P 500 index as of the close on Friday, August 7th. We closed bad news in the lower half of the range, but not that big of a deal. We've done that before. If price moves into this area here and this area here, based upon the rules, especially if we get into this area here, we will be required to reduce risk next week. This week we closed above all of the key levels that we were watching. Is there any basis for patience in the short run on this chart? Yes, if you've been following along on Twitter, you know that we had these green trend lines that we've been watching. You can see price intraday here with this little tail broke below the green trend line, and then intraday was able to rally and recapture it. It's a decent looking candlestick in this area. You can see this is similar to this, and then we rallied. This is all short-term information and really doesn't mean much until we can break into this area here and, more importantly, break above 2134. Is there anything else that's saying try to be patient and walk that fine line in the short run? Yes, the thin blue line here is the 200-day moving average for the S&P 500. As of the close on Friday, it sits at 2073 and change. Notice the low was 2067. We went below the 200-day intraday as well. We held above it here in February, and we held above it after toying with it in July. So we could get a similar look like this even under a bullish scenario where for multiple days we stay around the 200. But for right now, price closed above an upward sloping and bullish 200-day moving average. If we add in a standard Bollinger Band, which are bands created by John Bollinger, these are volatility bands. This is the upper band, this is the lower band. It's based on standard deviations. It gives us some idea of a range or area where markets typically flow. Hitting the lower end or lower band isn't necessarily a buy signal, but you can see when you're in a range, often when you get to the lower band, the probability of a reversal is probably a little bit higher than if you weren't at the lower band. On Friday, we came down to the lower band and bounced. You can also see even if you reverse, it wouldn't be unusual to hang around that band. You can also hug a band for long periods of time. It just says from a probability perspective, our risk reward here, we're at the lower band. If we move to the upper band, it's all the way near 2135 on the S&P 500. Lower band, eventually go to the upper band. Lower to upper. Lower, we hit the upper. Lower, we almost hit the upper. So if we did that again, our risk reward again, trying to be patient, this doesn't mean that the market's going to hold. None of this means the market is going to hold. It simply says there was a rational and mathematical and data-based reason to remain patient for a little bit longer relative to Friday's price action. Let's see what some of the standard weekly charts are saying used by the CCM market model. Regular viewers and clients know that this is a full-bore bearish look when price is below both moving averages. Blue is below red and the slopes of both are down. A full-bore bullish look when the probability of good things happening is higher is price above both moving averages. Blue above red and the slopes of both are up. How does the same chart look today? The answer is it still looks like a confused mess. However, it does look worse than it did a week ago. We have price below both moving averages, blue below red, and the slopes of both are down. That's the bad news. The good news is we did close above 2076, and you can see sometimes when you have a full-bore bearish look, support can hold and things can change. This chart is telling us that we have to respect a break of support and be willing to reduce risk. This is just one of many charts that are saying we have to respect downside risks if the evidence tells us that we've broken support. Similar concepts here. This is just a different set of weekly moving averages used by the CCM market model. Blue is on the bottom here and price is below when the probability of bad things happening is higher. Conversely, blue, the fastest moving average, is on top and price is above when the probability of good things happening is higher. This is the exact same chart using the exact same weekly moving averages as of the close on Friday, August 7th. This is SPY. We have a tight cluster of moving averages and a mixed bag. The bad news is a lot of these slopes now are down. The good news is while we are very, very close, blue and red are very, very close, we don't have any bearish moving average crossovers yet. So here you have all of your bearish moving average crossovers and risks are high. Here you have all of your bullish moving average crossovers and the probability of good things happening is higher. This is a higher risk mixed bag look, telling us to keep an open mind about a big move in this direction or a big move in this direction. Let's use some historical examples that are similar to show the importance of two points. One, nobody knows what's going to happen. And if you believe you know what's going to happen using a system like this, you are doing yourself a disservice, because you cannot maintain maximum flexibility once you start forecasting and bringing your ego into the equation. Similar situation, here's 2003, 2004. Weekly, the S&P 500 goes sideways for multiple months and consolidates, and you can see our moving averages get a similar look where blue is still above red, but just barely, and the slopes of the moving averages are starting to roll over. In this case, bad things indeed did happen next. From the period we were looking at, from a high to a low here, the S&P 500 dropped an additional 7.32%. These are the same moving averages on the same weekly chart. Now we're looking at a historical period from 1993. Similar situation. The S&P 500 moves sideways for multiple months. See the exact same point here as it is here. Momentum starts to slow, which is what we have today, and our moving averages are starting to roll over and cluster together. Why do we need to maintain maximum flexibility? Because as we noted in last week's video, there is no market law that says an ugly looking chart with a vulnerable and slowing momentum can't improve. Any ugly situation can improve at any time, which is why maximum flexibility is so important. From the point that we just looked at, from the low to the high, rather than rolling over and tanking, the S&P 500 rallied almost 10% from here to here. And we never got a bearish moving average crossover, and we never morphed into a full-bore bearish look. We don't want to extrapolate and say that we're going to roll over in 2015. We could roll over or we could rally. Notice here in 2010, 2011, we also have a similar look. Point to point, the market basically goes nowhere for several months. Momentum is slowing. The moving averages are rolling over. Very similar look with blue about to cross over here relative to red. A similar look to what we have as of the close on Friday, August 7th. Let's assume that I've decided in advance that the market is consolidating here on this weekly chart and going sideways, and that it's really not acting normally, so I'm going to suspend my rules and not pay attention to the evidence just temporarily. Let's let things clear up. If we decided to suspend our rules here relative to the last chart, that would have been a big mistake, because in this case, the slowing momentum turned into an additional 20.14% loss on the S&P 500 index. Now let's look at the strength of trends in 2015. This is the S&P 500 daily as the stock market peaked in 2007. This is October 2007. This is the final bull market peak. This is the 50-day moving average in blue and the 200-day, in this case, in red. Notice 1, 2, 3 times the intermediate term trend, or the 50-day, rolled over, and notice how close the 50 is getting to the 200. And the 50 is close to the 200 here for 1, 2, 3, 4 months really before really bad things start to happen. Also notice on the first pass down, the 200-day has a fairly steep slope, telling us that the trend, the longer-term trend, is still relatively strong. In that case, the probability of a bounce is higher because the longer-term trend is stronger. And indeed, we did get a bounce. Things change here. Notice before things really unraveled late in 2007 and early in 2008, instead of having that steeper slope with a strong trend, the 50 right here turns completely flat, telling us that the longer-term trend now at this point is extremely indecisive and almost an even battle between the conviction to own stocks and the conviction to sell stocks. Eventually, we get blue below red, and the slope of the 50 turns down again and crosses below. If we examine the same moving averages on the same daily time frame as of the close on Friday, August 7th, we see that we have a relatively steep, and this is a sustainable looking slope. You really don't want a slope like that. You prefer a slope that looks like a trend that it can continue to go up. The steeper a slope in a market, the higher the probability you're going to get a reversal. So what this is telling us is the intermediate term trend is unquestionably getting weaker, but it's not as weak as it was here. Look at the slope of that, look at the slope of that, and the slope of that. We really don't have anything like that yet. These are flatter slopes here. The intermediate term trend is rolling over, and the 50 is getting closer to the 200. That is relevant. The try to be patient piece of evidence really says that this looks more like this period here where we bounced and rallied for several months than this period here where the bear market really started to kick off in earnest. Here's an example of a fine line between patience and risk management. The market looks extremely vulnerable here on the weekly NYSE composite, and then it rallies sharply. That is not unusual. Very vulnerable. You get a big rally there. Resistance in 2011, resistance in 2013. What once was resistance may now act as support in early 2014 and later in 2014. We have the same trend line relatively close by. In fact, if we look at the same chart with high-low close bars, so this is the low, weekly low here, resistance in the general area, resistance in the general area, support, 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 and we recently have hit this line 2 times, telling us that in the short run we are at one of those fine line periods between patience and risk management. Patience pays off with a multiple week rally. Patience pays off with a multiple week rally. We're not saying that patience is going to pay off. We're just saying it's prudent to see what happens here. We'll get better information. If we bounce, we get better information. If we break in this direction, we know that a trend line that's been in play for quite some time will have been broken, and bearish probabilities will increase. No forecasting necessary. We'll keep an open mind and see what happens. Summing up some of the things that we've seen, the technical damage behind price is significant, which speaks to higher risk, yet price has yet to break down. If that does happen, the rules and the evidence in the market model will require us to reduce risk in big chunks. So something that we have to be ready for emotionally. Also have to be ready for the fact that the market could break support and then rally back sharply. Always have to maintain maximum flexibility. The bulls are never in full control, and the bears are never in full control. Remember, an ugly chart can improve, and a good-looking chart can deteriorate, which may happen if support breaks. We could snap back. The objective here, we want to put our capital in harm's way when the odds are in our favor, and we want to reduce our exposure to risk when the odds start to deteriorate. The objective is not to be perfect. We don't want every chess move or expect every chess move to be perfect. In fact, we know that some chess moves near a peak or chess moves near a trough will be wrong. Knowing that allows us to maintain that required maximum flexibility. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.